In my experience, we need a real precious metals bull market in order for silver to break out. In the gold trade, I don't think, well, we probably are in the early stages of a bull market. The move that we've seen in the gold price, while welcome to the gold adherence, is not anything like the move that we saw in the gold price in 1971 or 1976 or in 2002, 2003. Or in 2009. And it takes that type of buying. It takes a dramatic move in the gold price, and it takes a growing recognition of the precious metals narrative among generalist investors, not you and I, to move the silver price. And we haven't seen that yet.
Silver has lagged gold's performance, but that is a common occurrence. Whatever silver lacks at the beginning of a precious metals bull market, it typically makes up for it at the end. For instance, the current bull market started in 2018 when gold hit $1,160. Silver lagged gold for 2 years, as it did in the early 1970s, before staging a similar catch-up rally in the summer of 2020. Over the next 4 months, silver would surge nearly 150%. Just like in 1974, silver's catch-up was a sign the first leg of the bull move had ended. In his assessment, RickRule points out that the current rise in gold prices is much smaller than the big surges seen in 1971. 1976, 2002, 2003, and 2009. Concurrently, Rick explains that a dramatic gold price increase and broader recognition of the precious metals are needed to drive silver prices higher, which hasn't occurred yet. After gold's recent breakout above $2,500 per ounce, gold's continued strength above that key level should act like a magnet to pull silver toward the $50 level. Should it occur, a decisive break above $50 silver would complete an epic 45-year cup and handle pattern, and market technicians would then look for a slingshot move higher from there. According to him, central banks are responsible for most of the gold buying, while retail participation has been relatively tepid. Amidst the broader market trends, Rick spotlights a surge in silver equities, highlighting impressive gains in companies such as Silvercrest, Mag Silver, Abra Silver, and Vizsla Silver, especially following pivotal events like reserve valuations and cash flow boosts. Professional investors, including RickRule, are strategically positioning to buy quality silver stocks, much like the approach taken with uranium stocks in 2021, expecting a significant influx of capital. Now, we present the clips of RickRule's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
In my experience, we need a real precious metals bull market in order for silver to break out. And in the gold trade, I don't think, well, we probably are in the early stages of a bull market. But I would point out to you that an awful lot of the gold buying has been central bank buying. I would ask you to look at your own gold brokerage business in terms of retail participation. While it is true that for the last 20 weeks, there has been net retail buying, at least as evidenced through the ETFs, that retail buying is tepid. The move that we've seen in the gold price, while welcome to the gold adherence, is not anything like the move that we saw in the gold price in 1971 or 1976, or in 2002, 2003, or in 2009. And it takes that type of buying. It takes a dramatic move in the gold price, and it takes a growing recognition of the precious metals narrative among generalist investors, not you and I, to move the silver price. And we haven't seen that yet. What we have seen is dramatic moves in some silver equities that have performed as companies. Look at Silvercrest after the disappointment around the reserves valuation when they reached nameplate capacity and started generating cash. Stock's been on a tear. Mag Silver, stock's been on a tear. Abra Silver, Vizsla Silver, Aya Silver. The thing that I want to point out to your listeners is that the market cap of reasonable quality silver companies is so small that, first of all, when the generalist investor decides to crowd into them, there isn't enough room in the market caps to contain it. And secondly, there's a coterie of professional investors, myself included, who is willing to buy the high quality silver stocks in anticipation of the money coming into it, in the same fashion that there was a group of us willing to buy uranium stocks in 2021, understanding what would happen in the face of the uranium price increase. There's a group of us that are, I wouldn't say we're happy, but we're conditioned to being a year and a half or 2 years early. And what you're seeing in those high quality silver stocks is absolutely propositioning. Are we going to be early? Probably. Are we going to be wrong? Maybe. But it's a really interesting print if you think about putting together a portfolio of those companies where if you're wrong, you lose 30, 35, maybe 40%. And if you're right, you make 500% or 600% or 1,000%. It's precisely that juxtaposition of risk to reward your listeners need to familiarize themselves with. And while they all want the upside, they need to ask themselves if they can stand the volatility, if they can stand the time it takes to be involved in the trade. And most importantly, if they're willing to do the work to segregate in movie terms the good from the bad, from the truly ugly. Because there's lots in that latter category.
While reflecting on the market, RickRule emphasizes a minor gold price correction is possible due to high market confidence. He highlights that gold miners sometimes underperform gold itself, as seen from 2000 to 2010 when gold prices soared, but mining companies' free cash flow per share fell due to poor decisions. Gold prices have soared since the start of 2024 and have set record prices in major global currencies. While the performance of large-cap gold producers has been strong, the rally has not yet fully extended to the junior and development stage companies. This lag is not unusual in the early stages of a gold bull market. Historically, the initial moves tend to favor larger, more liquid producers before capital and interest flow down to smaller companies. He explains that junior mining companies typically lose money, making them risky investments. Despite this, he notes that a small percentage of high-quality junior miners and senior mining companies perform exceptionally well and can add value to the sector. Let's get back to the interview.
It wouldn't surprise me to see a little correction in the gold price, given there's so much confidence in the market. If the Fed does cut interest rates and gold doesn't respond dramatically, then the next move in gold is lower, which I'm okay with. I don't measure gold in weeks or even months. I measure it in years. And I feel very comfortable about what gold has done, starting with a starting point in either 1970 or 2000. I'm content in both circumstances. The discussion of gold and the gold stocks is much more nuanced. It goes like this. If you believe gold is going up, buy gold. That's insurance. You buy the gold stocks for a different reason. You buy them because you believe that they're companies that will outpace their competitors, or at least as a class, outpace the market. I would remind your viewers, or inform them if they didn't already know, that sometimes the gold miners can dramatically underperform gold. I point to the period 2000 to 2010, when the gold price advanced from about $250 to about $1,750. And the free cash flow per share on the XAU fell. It took real skill for the mining industry to turn a sevenfold increase in the selling price of their product into a reduction in free cash flow per share. But they did it. They accomplished the impossible. They put stupid projects into production. They did stupid mergers and acquisition. Importantly, they issued enough shares. In other words, they inflated their share counts dramatically enough that the free cash flow per share declined. I would urge your listeners to consider, too, we've talked about this before in your program, that if you come down to the junior miners, or those that purport to be miners, the junior mining companies per se, if you merged every one of them in the world together and formed one company, we'll call it Junior Explorco, that company would lose $2 billion a year in a good year and $6 or $8 billion a year in a bad year. So what do you pay for that industry, Donegan? Do you pay 8 times losses? 12 times losses? If it's in favor, 15 times losses? So there's reason for caution. On the other hand, both of those statistics hide the fact that the finest mining companies perform extraordinarily well. In the juniors, probably 5% of the 3,000 public companies worldwide generate so much performance that they add legitimacy and sometimes luster to a sector that loses $2 billion a year. And among the seniors, you don't have to own the XAU. You don't have to own all 40. You can own the 5 or 6 best companies. Yes, they are premium priced compared to the others by most metrics. And 2, if the gold price really goes on a romp, it'll be the inefficient companies that outperform the market, not the most efficient companies. In my declining years, Dunnigan, I'm okay if you take away some of my upside, provided that you take away most of my downside. So I would urge your listeners, irrespective of their focus on the big ones or on the little ones or on some of both, that they focus more on stock selection than on the gold price.
If you're bullish on gold, you should be even more bullish on silver. Long-term projections indicate continued growth, with prices potentially reaching $57.50 by 2035. How do you see the current trends in gold and silver influencing your investment strategy? Are you prepared to adjust your focus based on the evolving market dynamics? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.